Interest rates have been on everybody's mind in 2022. You may have heard the news that the Federal Reserve recently increased its federal funds interest rate. That's a major factor in the market's 2022 downturn, and it may even have taken a bite out of your portfolio. Even more, the Fed committee anticipates even more rate hikes at the remaining committee meetings later this year. Given this recent news from the Fed, in this video, I'm going to give you two things. Number one, I'm going to share with you some rules on investing in a rising rate environment. And number two, I will take you through some of the safest sectors and stocks to invest in a high interest rate environment that might even be high growth. Let's get into it. It's the first time since 2018 that the Fed increased the interest rate and the market is feeling it. And while it's been a while since interest rates have gone up, there are some key tried and true tactics to investing in a growing interest rate environment. Here are my 3 things to keep in mind. Number 1, generally speaking, tread lightly when it comes to investing in high growth companies. The share price of these companies today are typically based on future anticipated profits. And when rates rise, future profits are worth less today. Number 2, investors looking for investments during periods of rising rates can't expect all sectors to perform well. That's what Robert R. Johnson, professor of finance at Creighton University and the CEO of the Economic Index Associates, said when asked about the best sectors in which to invest amidst rising interest rates. He said the near certainty of Fed tightening and rising interest rates in 2022 means that investors should lower their expectations for broad equity market returns. And number 3, companies that have a high cash balance as well as historically have paid out pretty consistent dividends have a track record for performing well during periods of high rising rates. In fact, high dividend stocks outperformed the S&P 500 in 7 out of 10 periods of rising interest rates since 1960. Investing during periods of rising interest rates can be done successfully by shifting towards companies and sectors that tend to do well in the higher rates environment. Not sure what I mean by that? Well, I'm going to run you through 4 different sectors as well as some stocks within each sector that you may want to keep an eye on now that the Feds have increased their interest rate. Okay, first up, the energy sector. The energy sector has historically been a best performing sector in the period leading up to peak inflation. Inflation has been rising steadily since early 2021, so it's really no surprise that the energy sector was the best performing sector in the S&P 500 last year. As of January 2022, the Consumer Price Index puts inflation at 7.5%, which is its highest inflation rate since 1982. And according to a recent bank rate survey, we can expect at least another year of rising inflation. And if that happens, the energy sector could continue to dominate in 2022. That being said, the energy sector has seen a major spike in recent times as well as some volatility resulting from the war in Ukraine. So far this year, energy has been leading the S&P 500 and is up more than 30%. According to the financial information and analytics company S&P Global, energy was the only sector that didn't pose a loss in January. Overall, energy stocks have performed well in a rising rate environment, and this bodes well for investors in this sector now that the Fed has actually increased interest rates this year. Here are some energy stocks and ETFs to add to your watch list. First up, Devon Energy, which is an energy company engaged in hydrocarbon exploration in the US and is up roughly 140% in the past year. Second, Halliburton is an American multinational oil field service company and is up more than 50% in the past year. And finally, First Trust Natural Gas ETF tracks the ISE Revere Natural Gas Index, and in the past 12 months, FCG has rallied by over 60%. And before I go on, if you're finding this video helpful, be sure to like this video and subscribe to our channel so that you can tag along to all of our future videos. Okay, the next place to keep your eyes on is the financial sector. Financial stocks typically benefit from a strong economy and rising interest rates. Why? Well, banks make money from charging higher interest rates on the money they lend out compared to the rate they pay customers for their deposits. Similarly, brokerage firms earn money from the interest earned on cash balances held in client accounts and from lending out client money elsewhere. Insurance companies can also make a profit off of the spread between what it owes its policyholders versus what it can make with its investors. investments. Insurance companies invest a portion of premiums into the bond market, and when rates are high, they can make a greater amount off of the spread. The financial sector was among the market's top performing sectors in 2021, and as a result of rising interest rates, we may see this continue throughout 2022. But Refinitiv data shows that financials tend to underperform in the year leading up to peak inflation. Whether 2022 is one of those years remains to be seen. However, the financial sector is down 2% year to date. However, in the year after inflation has peaked, the financial sector tends to be the best performing sector on average, which means that some of the biggest gains have yet to come. These financial stocks and ETFs have done really well in the past year and could continue to do so despite rising rates. First up, Upstart Holdings, which is an AI-powered lending platform, and its stock price has risen around 90% in the past year. Second, Wells Fargo & Company is an American financial services firm and is up nearly 30% in the past year. And finally, Financial Select Sector SPDR Fund, also known as XLF, tracks the Financial Select Sector Index. Its top 3 holdings are Berkshire Hathaway, JPMorgan Chase, and Bank of America. The price of this ETF has increased by around 12% over the past 12 months. Okay, so energy and financials are 2 potentially good plays that could protect your portfolio and maybe even outperform the market. Stick around for the rest of this video. I'm about to share with you 2 more sectors as well as some stocks in each to help you beat rising interest rates. The third sector I'm going to talk about is real estate. Rising interest rates can pose challenges to real estate investment trusts, or REITs. This is because higher rates can increase REIT borrowing costs. But if interest rates are rising due to a strengthening economy and higher inflationary activity, REITs can actually benefit from increasing rates. REITs typically benefit from inflationary periods and periods of rising rates because real estate owners typically have greater ability to raise rents and pass that income on to the shareholders. According to investment management firm Cohen & Steers, REITs over the last 3 decades have had a 10.8% annualized return in periods of rising rates and positive economic growth. Behind energy, real estate was the market's best performing sector in 2021. The sector has been down nearly 10% to date, but history does show us that REIT returns increase more often than not during periods of rising interest rates and inflation. Check out these REIT stocks and ETFs that have been doing quite well over the last 12 months. First up, Preferred Apartment Communities, or APTS, is a Georgia-based REIT that engages in the ownership and operation of Class A multifamily properties and grocery-anchored shopping centers. It is up a whopping 150% over the past year. Next up, Blue Rock Residential Growth REIT is a REIT focused on acquiring institutional quality apartment properties in demographically attractive growth markets. Its current 12-month performance stands at around 130% at the time of this video. And finally, Vanguard Real Estate Index Fund is an ETF that tracks the MSCI US Investable Market Real Estate 2550 Index and has gained roughly 15% in the past year. Now, I know that real estate is a hotly debated topic right now. Some people think it's totally overvalued, while others think it's the next great buy. I want to know what you think. Let me know in the comments below. Another sector to keep in mind during periods of rising interest rates are consumer staples. This is because when interest rates go up, people may be more attracted to saving over spending. Rising costs can make people think twice before spending money on big-ticket items. However, people still need to spend their hard-earned money on staples like food, grocery, and hygiene items. And while these companies also battle rising inflationary costs, they usually have a little bit more leverage because they can pass some of that cost on to the consumer. That's me and you. A recent report from investment management company Hartford Funds shows that along with energy, equity REITs, and financials, the consumer staples sector has outperformed every other sector during periods of rising inflation between the years of 1973 and 2021. As rates go up to battle rising costs, consider investing in stocks that have higher pricing power. These are the ones that are able to increase their prices with inflation better than some other industries. Here are some consumer staples, stocks, and ETFs to consider watching. First up, Tyson Foods. This is an American food company and the world's second largest producer of chicken, beef, and pork products. It is up roughly 15% in the past year. Next up, Coca-Cola. This American beverage corporation has seen its stock price increase by roughly 17% in the past year alone. And finally, the Consumer Staples Select Sector Fund. If you're looking for broader exposure, then XLP tracks the Consumer Staples Select Sector Index, which in turn holds stocks like Procter & Gamble, Coca-Cola, and PepsiCo. Okay, so there you have it. Those are the top 4 sectors that have been shown to perform well during periods of rising interest rates. I hope these ideas got you thinking about how to adapt during these crazy times. I'm interested to know how you're investing for the months ahead. Let me know in the comments below. Thanks for watching.